Hello everyone, this is Plahari. The company I have been allotted is Tata Motors. Basically in this report, I have covered fundamental analysis, ratio analysis and equity valuation using discounted cash flow analysis. Now coming to fundamental analysis, I went through the overview of Tata Motors, effect of recession and Wall Street expectations on Tata Motors. I even did SWOT analysis and Porter's 5 forces framework and macroeconomic factors that might impact the company. So, from this fundamental analysis, we can see that due to recession, the market went down, but now it is improving. The weak market conditions have led companies to introduce new models and offer customized loans at cheaper interest rates to attract new buyers. The production, sales, and revenue of Tata Motors is likely to rise. Now, coming to the ratio analysis, we see that the ratios of the company are in par with the industry's average, but it can be improved. Let us go through some of them. Now, first let us go through EBITDA margin. EBITDA margin, as you all can see this, it's good to have a higher EBITDA margin. So the company is in a better off position compared to its competitors. Now, asset turnover. Asset turnover is actually good to the company if it is high. So it's actually in par with the industry's average. Now, current ratio and quick ratio, both are less than 1, which are actually red flags to the company. So the company has to improve the current assets. Now, debt to equity ratio. Debt to equity ratio of greater than 1 indicates that the company is over leveraged and expanding. So the company should take care of this. And now, price to earnings ratio. Price to earnings ratio is high for the growth potential companies, so it's actually good for our company and it can be improved even. Now, price to sales per share ratio. It's high for the growth potential companies and now it's even in par with the industry's average. Now, enterprise value by EBITDA ratio. It is the sum the other company has to pay to acquire it. It should be high and it's decent enough for our company. So for any investor who is investing, I suggest it's really good to invest in this company. And now coming to equity valuation using discounted cash flow analysis and free cash flow for the firm, I have calculated WACC from RM, RF and beta values, and from all these we get the valuation per share using DCF as $22.69 and the valuation per share using FCFF as $14.31, which is very less than the current price of the share, which is $28.8. So the stock is overvalued. Now coming to the summary of the entire report, the fundamental analysis says that the production, sales and revenue of Tata Motors is likely to go up. A ratio analysis says that the values of Tata Motors is in line with industry average, but it can be improved. And equity valuation using discounted cash flow analysis and free cash flow for the firm says that the stock is overvalued. So from all the above, I suggest to sell the stock immediately and buy it later. Thank you.